IRA Saturday webinar. My name is Nicole Fana. If y'all don't see me as much, but I'm actually one of the masterminds behind our online social media presence in our marketing department at Quest Trust Company. Today, I'm going to quickly do some announcements right before I introduced Perry and Ed. So we're really excited about their presentation. Case studies are always a huge hit with any classes that we do. So before we get started, I'll go ahead and go into some announcements, and then Perry and Ed, I'll go ahead and let you guys take it away. Sound good?
Awesome.
All right, give me 1 second, guys, while I pull up this screen. All right, perfect. Are we seeing the right screen? All good? Fantastic. So guys, thank you for joining us for our Self-Directed IRA Saturday. We do these every Saturday. They're a huge hit since the pandemic hit, but let's go ahead and jump right into it. Before we get any further, breaking news. I'm sure if you guys follow John Heyer, he's an IRA lawyer, or Jeff Watson, or pretty much any self-directed IRA custodian in the industry, you're well aware of the budget reconciliation bill and how there was some provisions that were affecting IRAs and 401ks as far as severely limiting self-direction. Well, earlier this week, we got confirmation that all IRA and 401k provisions have been dropped from the reconciliation bill. So yay! But with that being said, we still must remain vigilant. It's good news for now. Victory. Really good stuff for right now. But let's make sure that we're still watching the news, just that way they don't sneak that kind of stuff back in there. Because self-directed IRAs are a huge, powerful thing that American citizens have at their disposal. So let's celebrate this victory, but also let's make sure that we're staying informed in anything like that. So really good news on that end, that we're self-directed IRAs are good for now. But for those who have not heard of us, who is Quest Trust Company, right? We're the largest self-directed IRA custodian in Texas, right? We have 20,000, I think this number is bigger now, of active investors all across the country. So just because we're based in Texas does not mean that we're only in Texas. We actually have clients nationwide, all across the US, and even some in other regions like Puerto Rico and stuff like that. We have about 2.1 billion in assets under management. So as you know, we help administer those self-directed IRAs. So that's the amount of assets and that cost, with it. But not only are we the largest self-directed IRA custodian in Texas, I would like to say we are the most educated. We have about, I think, 110 employees now, but we have about 35 certified IRA service professionals. They go in with the American Banking Association, they take that test, they become certified because they know all these things about IRAs and how they can help you. So we are highly trained, highly qualified to be able to talk to you, not just IRA specialists, but also we have transactions managers that are ASPs. We have our special services department that deal in those IRA laws and working with IRS and stuff like that. We have, just all those people, not just specifically IRA specialists that are super high qualified to be able to help you in all your IRA needs. So that's also something that's pretty unique to Quest. And we have about 400 million in undirected cash. So, one of our top investments is lending money out of the IRA. So as you're coming to maybe those networking events and you come across a Quest client, you need some money for your deal, that's one of those popular investments that you can do at Quest Trust Company. But with all the stuff that we do, all the education we provide to you guys, these kinds of webinars, other in-person networking events, all those blogs, educational videos, we do not give any tax, legal, or investment advice. We don't endorse any persons or products. We are not licensed to give that kind of advice. So we are here for strictly educational purposes. So if you are looking for tax or legal advice or structuring advice for your investments, make sure you reach out to a licensed professional for that and doing your due diligence with that as well. But so really quickly, you know who Quest is, but really what is a self-directed IRA? Bottom line, a self-directed IRA is really just a marketing term. The IRA itself is no different, no legal distinction between an IRA you would find at a place like Fidelity, Charles Schwab, where you would use that IRA, that retirement account, to invest in stocks, bonds, mutual funds. The only real difference with a self-directed IRA is that instead of a stock, you are buying a house per se, right? There's so much more you can really do. But That's really the only legal difference. It still follows all the same rules, still follows all the same tax codes and all that stuff. But the benefits are a miss, right? So you have your diversification covering that private side, like the private investments like houses and lending out money, and then also investing into things like LLCs. So you have that whole other side of the spectrum that you wouldn't have with investing with just a public custodian. Tax savings, I feel like it'd be much easier to, or not easier, but it'd be, you save a lot more money buying a house with a tax deferred entity like an IRA than you were to do it yourself, right? So think of all the tax savings you could have with just using an investment in an IRA versus a personal one, right? Social investing, you have that ugly eyesore in your neighborhood. You want to help, rehab that house. Now it's one of the pretty houses on the street. So it helps beautify the neighborhoods. That's something that a lot of people do with their IRAs. And then also, if you understand real estate, like I understand real estate, I'm not really familiar with stocks, bonds, mutual funds, not like my brother or my dad, but I know real estate. So why not use my IRA to invest in real estate? And so should you, And quickly, here are the steps to purchase an IRA. You open the account, really easy, fund the account, transfer or rollover from a 401k, a previous IRA, come to these kind of events, network with people, check in your local area. Once you find an investment, you do your due diligence, you complete that investment paperwork with Quest Trust Company, and then boom, 24 to 48 hours later, once everything's good to go, your investment is funded with the IRA. So real simple stuff. Now, what we're going to do real quick before we go ahead and get our introductions in, I want to invite everybody that's on this webinar, if you are in the Houston area or Dallas or Austin, we are doing our in-person mixers. They are back. We are doing one once a month for each office. So our Houston one, if you're in Houston, is going to be November 2nd in our Houston office. It's called Harvest Your Wealth. And basically, you're just like the title says, you're feeding your mind, you're feeding your stomach, but you're also feeding your IRA. So we have this event with a panel of some of these really high, high net worth people in the real estate industry, all going to talk about how self-directed IRAs have helped feed, their wealth, how they help grow their wealth, harvest their wealth, if you will. So make sure you RSVP. It's a completely free event. And then also, if you are in the Austin, Dallas areas, check out those. We have one every Tuesday for each month. So, and then real quick, if you are not having your ticket right now to QuestCon Live 2022, go ahead and get your ticket. This is one of our biggest online virtual conferences of the year. We do this a couple times a year since the pandemic hit to replace our Quest Expo. It's been a huge success since then. You'll learn all the things that, what happened in the 2021 real estate market, what we're doing now, and then all the things that we hope to see in forecasting for 2022. So, we're still in early bird prices right now. Those end very soon. So go ahead and get your tickets. It'll be an online conference from December 3rd through 4th. I'll go ahead and put the link in the description. If Manny isn't necessarily here, he's actually helping me moderate today. But go ahead and get your tickets. And if you want to go ahead and get 30% off of already discounted tickets, go ahead and use the code QuestCon30. This will give you 30% off. And we also offer endless education, right? So not only do we have these webinars, we have a whole YouTube page, a whole education center right on our website, going over so many different kinds of things. So this is all free for everybody to view. So if you haven't subscribed to our YouTube channel yet, go ahead and do so. And we post like several times a week. So you'll get a bunch of really awesome free education, including this webinar that I'm actually really excited about today. And if you have any questions about anything IRA related, the reconciliation bill and what that truly means and everything like that, or if you just want to come and chat with somebody about, just questions at all about what you need to do moving forward, or those kinds of networking events that you can find, just call an IRA specialist at 855-FUN-IRAs. You can chat with us live on our website as well. It's not a robot behind that chat box on our website. It's actually a real live IRA specialist. So it's a real person. So if you do need to contact somebody, we have a bunch of resources for you guys to contact. But without further ado, I think we're ready to go. That was just my quick little spiel before we kind of get things started, just to get more people on. So we have Perry Zheng here. He is the founder of Cashflow portal, and then Ed Sittler, and is the principal of Sigma Real Estate. So these guys are going to go over about 3 case studies of deals that they've done that they didn't win, but they're going to share the lessons that they learned and then how those lessons have helped them achieve bigger and better things. So I hope you guys really enjoy this presentation. I'm very excited, and you guys go ahead and take it away.
Hello. You folks can see my screen, I hope. So we're going to talk about 3 deals that got away from us. Here is the agenda. We'll talk about a 8-unit deal in Tacoma, Washington, a 20-unit deal in Burien, Washington, a 100-unit deal in Dallas, Texas that we did not win, and the lessons learned from it, and some of the Q&As. You can ask questions and type those into the chat room. I do want to make this super interactive, so please do so. So first, an introduction, also kind of the present day Perry. I am the founder and CEO of Cash Flow Portal, a real estate syndication software. Some of you may have used that already. I was previously an engineering manager at Lyft, and I was also a software engineer at Twitter and Amazon before that. So I came from a tech background. Personally, I bought 7 single families in San Francisco and Seattle area. Currently, I am the operator and sponsor of 850 plus units and passively invested in more than 2,000 doors. Okay, so that's the present day me. Also, I am a very frugal person, so I still live with housemates and I travel a lot. I also have a lot of credit cards because I like playing the credit card game, and I like playing poker just in my personal life. So my friends used to joke that everything I like has to do with money. So, and I'll hand it off to Ed Sittler.
All right, thanks, Barry. So I'm currently a full-time multifamily syndicator since 2018. Before that, I had a career as a paralegal for about 10 years or so. As of today, I'm a GP and asset manager of just over 1,000 units in Dallas, Fort Worth. I've invested in some deals as an LP as well. And I actually just moved to Austin about 2 months ago from Dallas. I'd been in Dallas for 3 years. I had moved there from San Francisco. So actually it coincided with Perry and I kind of making the commitment to go into multifamily. And I guess we'll talk a little bit more about that, process as we go through. But that was obviously sort of the start of our whole journey in this business. So made the move from San Francisco to Dallas. It's been an interesting ride so far, as we'll go through a couple of our more interesting deals and experiences on this webinar. So the first one we're going to talk about is an 8-unit deal in Tacoma. So this was before we kind of dove into, I guess what I would call true multifamily, right? This is back when I was still in San Francisco at this time. And we had done, before this 8-unit, we had done a 7-unit also in Tacoma. So that was kind of our first technically multifamily. We had done some single family before that. So this was kind of around the time when we were really trying to move into multifamily and start to actually scale up. So this one, it was kind of an unprecedented situation. I don't know that I've ever heard of this happening. Everybody I've told this story of this deal to, I think, has never heard of this happening before. But we literally had gotten all the way to closing, like the day of closing. Everything was, all the documents were signed. Lender was ready to fund. All the money was ready to go. And what happened was we needed 1 extra day to close. So, not uncommon, right? The lender was a little slow. They need an extra day or two. So, we had alerted the broker to that, probably, a couple of days before. And we thought the broker had, confirmed it with the seller. We were all good. I mean, you're in general, you're usually, I guess, incorrectly for us, but you're usually making the assumption that, it's all good, right? Unless you hear differently. So, we told the broker, we thought everything's good. So, the next day, we get a call from the broker, and he says, seller decided not to sell. And I mean, obviously the broker's, pissed off about it too, of course, because, they're, I don't know what their deal with the seller was, but obviously it's not good for the broker either if they're not closing. And so, we were just kind of shocked, obviously, kind of scrambling, trying to figure out what we could do. As time went on, we started talking to, attorney to see if we had any recourse, if we could force the seller to perform. It was kind of one of those gray areas, I think, in the contract. And so, we actually did spend a decent amount of time and money, on this attorney trying to dig into, if we could really force the seller to perform and close on the deal. And, ultimately it looked like it was just going to be kind of a toss up if we actually tried to sue the guy. And, we probably would have just ended up spending a lot more money with really not much certainty as to what the outcome would be. So, what we ultimately decided was that it was just not going to be worth the expense. And we just ended up dropping it and moving on. And so, so the lesson, I mean, I guess that, the big lesson on this one, there's a couple. One is, you can't always rely on good faith, right? I think, although, in real estate, obviously we have lots of contracts and, legalese and legal documents. But, a lot of this business is still based on just kind of relationships and trust. And, this guy, this seller, I have no idea what happened to him after that, what he ended up doing. And I don't think we really kept in touch with that broker either about it. But, this guy probably burned his relationship with that broker, right? I mean, that broker is certainly not going to work with this guy again. And he might have, I don't know what his reputation in the business was. Obviously, he's a small scale guy. He was selling an 8 unit. I don't know if he had lots of other properties or if this was his real business or not. But, if he was like a full-time real estate investor, I mean, something like this could probably really end up hurting his longer term prospects in the business. So, it's one of those things where, these relationships matter, and doing what you say you're going to do in this business, I think, really matters. So, maybe he just decided, I think I can get a better price if I wait and sell later. Who knows what his real reason was. But, a lot of times I think it's better to, it's better to keep your word and do what you say you were going to do, even if that means maybe not getting technically the best result for you at that particular moment. And so I think that's a big takeaway. And I think the big takeaway for us as well was just, this was a sunk cost, right? We had spent so much time on this deal. Obviously, the whole acquisition process, contract process, months on working on this deal. We had taken money from our investors, right? So it was a risk of harming our reputation as well with our investors, right? Because they had already sent us the money. We were ready to close with their funds. And so, what we ended up doing, we returned the investors' money. We provided them with like a 5% interest rate to just sort of, cover the time cost of that money that obviously they had it just, sitting around and nothing, it didn't get used for anything. So, we felt like that was, something that we should do for them because, to help kind of maintain our own reputation. And then, the other big part is, I think, just looking forward instead of looking backward. You can, I mean, not gonna lie, I still get pissed off about it when I think about it today. It's just one of those things I'll never probably totally get over, even though it's like, what is this deal compared to what we're doing now? It's nothing, but just one of those things that sticks with you. But ultimately, we moved forward, and it was, I think, for the best, as we'll kind of talk about as we go along.
That's awesome. Thanks. The next deal is a 20-unit deal in Burien, Washington, which is about 5 minutes away from where I live, even today. This deal is personally very important to me. And by the way, if you are joining late, you can see the meta point here is these are all the things that happened before we quote unquote made it. We are peeling back the curtain to show all the kind of the dirty things that happened, all the things we didn't get until we got that one deal. So I personally thought it's very interesting. So this is a 20 unit. It was selling for 3.2 million, about 5 minutes away from my place. Every time when I come back from the airport right now, I still drive by that property. So to this day, I still want that property. It's a very, very good looking property. I did the due diligence, talked to the broker, absolutely want to have it. I said I will manage it if I need to by myself. I have the pitch deck ready, have the research ready. We wrote like a 16-page business plan that got the lender approved. And we were ready to make an offer. And we made an offer of 3.2. The ultimate buyer also made an offer of 3.2. And the seller decided to give it to the other buyer. And so Ed and I were definitely very sad. And we were sad basically for like 24 hours. And then we decided that, in retrospect, if we offer $50,000 more, a 3.25 million, we probably will have gotten that property. And just for some context, at this point in time, we got a 7-unit. This is back in 2018, early 2018, and we're trying to scale in the state of Washington. And the year before that, I went to this almost like a mentorship program, a R2R. And I decided that I was going to strike out on my own and not join any mentorship. This was the deal that was the tipping point, that if I were to spend $50,000 more to get this deal, why don't we just spend $50,000 more, which is $25K for me and Ed, to join an actual mentorship program? That money will pay dividends for many deals into the future. And that was the light bulb that went off. Now, I also asked the broker on why we lost. The broker said that this particular buyer had 70 million-ish of assets under management in that area. And we have zero, basically. They have their own property management company even. And obviously, the buyer has to give it to the seller has to give that to the buyer. So it's also just the harsh reality that reputation is important, and that what you have and your team is super important in winning the deal. And so that's when I decided that I have to join the mentorship program. So the results here is went back to that R2R, Rat Race to Retirement event. And this time, it was my second time going there. And this time, I didn't even care about what the speaker said. I'm joining. Doesn't matter what he said. So I joined. Ed also joined about a week later. And Ed was going to quit his job during that time to move to Seattle to do fix and flips with me in Seattle. But because we joined the program, Ed decided to move Dallas, a city that he had no particular interest of going at the time. But that's just commitment. It shows that he's willing to do whatever he needs to do to get a deal done. And so this is the second deal we lost. And you can see that it felt, in retrospect, it should have felt hopeless. But at the time, I think we're just too naive to believe that we screwed up like multiple times. We're just like, okay, that's another failure. Let's move on. Let's get another deal. So So, all right. Let me hand it over to Ed to talk about the 108 unit in Dallas.
Yeah, so this one was a little bit farther down the road. This was in April 2019. So at this point, I moved to Dallas in September of 2018. So, a little less than a year at this point I'd been here, and I just been working full time on trying to get a deal basically for like a year. So, I'd quit my job as a paralegal in San Francisco. As Perry said, I was originally planning on moving to Seattle and trying to build up our business there. But then, of course, our plans changed once we joined the mentorship program that was more based in Texas. And, I think that also convinced us that Texas was just going to be a better market for us than Washington. And especially like the Seattle area is just, prices were going crazy there. And less deal flow and all that. Obviously, Texas just, is the most deal flow pretty much anywhere. And so, it was just really within a period of probably a couple weeks that I just changed my plans. Instead of moving to Seattle, decided to move to Dallas, and had really never been to Dallas before, aside from that one event we had been to when we joined the mentorship program. So, I mean, it was a big learning curve for sure. So a lot of those early months were just kind of trying to lay groundwork, build a network, meet brokers, looking at lots of deals. But it took some time. So this one came around in around April 2019. At that point, we had started to kind of make offers pretty consistently, probably for the last few months at this point. So we've been making a lot of offers. We've been getting, a lot of best and finals, getting really close on a lot of deals. So it was kind of a point where we felt it was sort of inevitable, I guess, that we were going to get something eventually. We just kind of kept falling just a little bit short, it seemed like, time after time. And I'm sure a lot of people, in this business have that same experience, not uncommon in this, competitive market. And so on this particular deal, we were in best and final, and we were actually, nothing had been technically awarded yet, but we were being told by the broker that we were basically the top offer, and essentially get ready to, start moving with, contract and all that stuff. And then literally next thing we hear, the seller decides not to sell. So it's kind of like, deja vu all over again. Obviously this one's not quite as bad because we weren't even under contract. We just, thought we were about to be under contract. So not quite as devastating, but, still super frustrating. This seller, he was actually the original developer of the property back in the 80s. And he was selling it as a portfolio. This one was the smaller deal, and there was another larger one that he was selling at the same time. And from what we were told, that he had misjudged his tax situation or capital gain situation, and basically decided that it was not opportune for him to sell both at the same time. And so he did go through selling the other one, but this one he did not. And actually, the funny thing with this one is that it did just sell maybe a month ago or so. It has sold to some other people that are part of our same mentorship program who we actually know pretty well. So just a kind of one of those weird coincidences. But I mean, it's basically 2 years later. So he held on to it for another 2 years. And of course, it sold for a lot more this time around than we would have bought it for, than our offer was for. So, it's not necessarily more painful, but it was just interesting to see kind of, where it would have gone if we had bought it at that time versus what it went for now. And I think, you know, in retrospect, I'm probably glad that we didn't end up winning it, because it was actually it was a good location, but it's really not an optimal probably unit mix in terms of what we're looking for. It was like all small 1-bedroom units. So that's the kind of thing that today, if I'm looking at a deal, that would probably just be a no-go right off the bat. But I think at the time we were just like so intent on getting a deal that, you know, you're more willing to overlook some of these things that might be kind of yellow flags or warning signs when you're first getting started, because you just want to get that deal. But ultimately, I think it was not the best deal for us for our first deal. And so, you know, kind of the result, I guess, of that failure on that deal was we just kind of doubled down and just, you know, kept going for even bigger deals. And shortly after that, we ended up winning what would be our first deal in Texas, which was 172 units. So, you know, and I think ultimately that was probably, you know, a better deal for our first deal. And we're actually selling that one right now. So just about 2 years later, we're selling that first one. And we can talk about that one a little bit later on. But that one's, it'll end up doing, I can just go over it now, I guess. So that one will end up doing about a 70% return to our investors in about 2 years, which actually, I mean, it sounds pretty good, but it's even that's a bit of a disappointment, because this sort of another lesson on this deal, the 172 unit, was we, you know, obviously being our first deal, we didn't necessarily know everything about, you know, all the different kinds of loans and all the different kind of loan terms you can get and what the implications are. And so we had a 12-year Fannie loan with yield maintenance, which was kind of like a popular option at that time. A couple of years ago, a lot of people were doing those 10 or 12-year Fannie loans with yield maintenance because you get the lower interest rate. And, you know, I think we sort of knew what yield maintenance was, but kind of didn't really take all the implications of it into account, right? And the fact is, you know, yield maintenance means if it's a 12-year loan and you're selling in 2 years like we are, you owe essentially all the interest that you would pay over those 10 years when you sell. So in our case on this deal, it's over $2 million of a prepayment penalty. And so we're literally, so we're selling as an assumption, loan assumption. It means the buyer's assuming our existing loan. So we're not going to pay that yield maintenance, but of course that means we're selling at quite a bit lower price than we would if it was free and clear. And so, you know, obviously we looked at holding it longer. We looked at different options. And, you know, even though we're literally taking like $2 million plus hit, you know, we're just leaving that money on the table, which is painful. We ran a bunch of scenarios and we still decided that, you know, selling now is the best course to maximize our investors' IRR. And, you know, they can roll their money over into another deal and probably ultimately get better returns that way than if we had just hold it for another few years. So, you know, that was another tough pill to swallow, and a big lesson learned for sure on that. So I would say anybody out there looking at a yield maintenance loan, I'm not going to say never do yield maintenance, but definitely at least make it the period as short as possible. You know, I think it's for sure worth taking a little bit higher interest rate if it means you're not going to have yield maintenance, or if your yield maintenance period is significantly shorter, because you'll get paid back a lot more on the back end when you sell it versus whatever, you know, your higher interest rate is. So that's what I would say about the yield maintenance. But you know, overall, I think it was a good deal for us. You know, everybody still gets a good return. Everybody walks away happy, and you know, it's also great to just go full cycle on the first one have that experience. So, Perry, do you want to? I guess I can do this lesson learned overview here. So, yeah, just kind of the big top line, I guess, lessons from these deals overall. The first one is, we failed forward, we didn't fail backward, right? So every time we failed, we use that as like motivation as opposed to becoming discouraged. And I think, every time we got super close to a deal and lost it, and I mean, there were more than these three for sure. there were many deals that we came close on and lost. And so I think we just use that as fuel to kind of drive us towards getting that first deal. Because, it's certainly, there were times when I would become discouraged, but, you just have to make the decision that you're not going to view it as a setback. You're going to view it as kind of a learning experience, and you're going to take that knowledge and apply it and do better every time. I think we were also kind of naive starting out. Obviously we'd never really had, failures of this type before. We'd, done some small deals, bought some small properties, but, getting into the true multifamily market, it was a whole different animal. And so I think coming in, we were like, oh, we know what we're doing, right? We've done real estate before, but it's a whole different animal for sure when you're getting into like the real commercial stuff. And so I think it was a little bit of a little jarring, I think, when we first started, making offers and realizing that we actually maybe didn't know as much as we thought we knew. But again, we use that to just keep learning and keep improving. And then finally, I think, the key point is that we were really just willing to do what it took to get into this business. Like we talked about, I quit my job and moved to a new city. And I had no income for a whole year because I had decided that I was not going to get another job when I moved out to Dallas, and that I was just going to go all in, on this business and do everything I could to get that first deal. So, Perry, when he would visit me, he would just kind of like sleep on a extra mattress in my apartment. So, we were just being like super frugal, like, just trying to do everything we could to get that deal. And I think that was kind of the biggest key to eventually getting that first deal and then getting some momentum, and getting to where we are now with a few deals and 1,000+ units. So those are kind of my big takeaways from kind of this whole experience.
Cool. And then for me, here are some lessons for passive investors. So I think a lot of people watching this are passive investors. These are some of my philosophies as a sponsor and also as a passive investor. Ironically or paradoxically, the first deal usually means the sponsors are highly motivated. Just put yourself in our shoes. First deal, man, it took like 4, 5, 3 deals that we almost got it and we didn't. And then at least 10 deals that we made LOIs on that we got into the best and final and we didn't get it. And we're gonna do well on this very first deal. So if you are a passive investor and you're looking at a sponsor that's a new sponsor, if they have high integrity and they are competent and they have grind for a year on getting their first deal, they're going to be motivated to succeed. And so first deals often do pretty well despite the lack of experience. And that experience, it came from the different mentorship programs, and that's all they have. Compare that to maybe sponsors that have like 15 deals at this point. They may not have time to pay attention to the new deal they're doing, unless they build a system to scale their operations. Now, the second lesson for passive investors is for those who want to become active, it will take about 9 to 12 months for you to get your first deal. So, and there will be a lot, it's a business, it's a grind. So be realistic about what you sign yourself up for. We are always here to talk to you if you want to get your first deal. We're wanting to help, and which I just love talking to investors and future sponsors. Be realistic, but also know that this is a long-term game. You actually don't make that much money as a sponsor on your first deal, because your acquisition fee, it's none. Your carry is almost very little. You're probably gonna charge a less of an asset management fee, and that first deal is probably not that big, and you're gonna bring in sponsors. By the time all said is done, you probably make almost pennies until the deal actually does well. Now, once you do well, the second deal becomes easier. The third deal becomes really easy. At this time, we're saying this because we feel good about it. Our latest deals are usually raise money within a week. First deal took us like 2 months to raise all the money. We literally grind until the closing. So peel back the curtains. It's actually not as glamorous as it looks. There's a lot of hard work that went into it on your first ones. And but the third lesson is, in order to become a sponsor, I do believe there's a lot of value of investing in other people's deals initially. When we first joined the program, we probably became passive investors like 5-6 deals, a little bit too fast, to be honest. But because we are passive investors, we actually can have a seat at the table in demanding conversations with these sponsors. Right. The worst thing you can do as a passive investor is pretend like you're gonna invest and you don't invest, and the sponsors are gonna see through that right away, and they probably wouldn't talk to you a lot. Like, we probably don't do that, but I know people do that. So don't do that. If you're interested in investing, actually invest. And sometimes you don't have to invest 50K if you want to reserve capital to do your own deal. Do like 25K. I'm sure they will probably let you in. But be genuine if you want to invest. And it is a good idea to be part of their deal so that you just actually become, loose business partners. You can also see how they communicate and how they respond to their investors so that they could become the best, you can think about if you want to partner with them in the future. Many co-sponsors used to be either KPs or LPs in their co-sponsors deals, right? So don't burn bridges by pretending to invest and not invest. If you're serious about it, do invest. Yeah. So these are my lessons. And then that's it. Here's how you will contact me, perry@cashflowportal.com. And then Ed, that's Ed's email. Feel free to reach out to us. We'll just kind of pause here for questions and probably running out of time too.
Well, that was a very good presentation. I actually, I saw a lot of those really good lessons learned at the end. I was like, oh, I didn't know about that. So that's really good stuff. Guys, if you have questions, go ahead and put it either in the chat or in the Q&A. Perry, Ed, this has been a really good presentation. We still have about 15 minutes left. So if I'm not really seeing any, y'all must have had a really good presentation because I'm not seeing any questions. Y'all you covered a lot of different things. Even the questions that I was going to ask you were covered at the end. So I was like, oh, well, that's cool, But guys, if you have questions, go ahead and put it in the chat. If not, we might go ahead and just end early. But before we do, Ed, Perry, you provided a lot of insight, a lot of, really in-depth, lessons learned from what you guys have been doing. Do you have any closing remarks we got one question before the closing remarks. We have one person asking, what is the minimum money required to invest as a passive investor? Well, what do you guys think on that one?
think Perry kind of mentioned, right? It's like, usually on our deals, at least it's usually 50,000, but if somebody, if there's spots available and somebody wants to do 25 or something like that, we'll often, make a concession. So it kind of just depends, on a deal that's, if they raise all the money in, 24 hours, yeah, you're probably not going to get it with a lower amount, right? But if it's a raise that's taken like a week or so, and they still have some spots. So it kind of is going to depend on how long the raise is. But I would say most deals that I see are a minimum of about 50 to 75, generally speaking.
Okay. And I know that's not even just particularly with those kinds of deals too. If let's just say in any aspect of passive investing, I mean, I know I invest with with my IRA in general, and I've only invested about $6,000. So it can even be as low as that, but definitely with your guys' deals, probably much higher ROI than anything that I would have done. So that was that question answered. Guys, anything else before we go? Anybody else?
A couple other questions just about the ROI and stuff. Yeah, so we do distributions quarterly, generally, and we usually underwrite to a 5-year hold. So the hold time, obviously we're selling our first deal in 2 years. I would say recently it's been more common for deals to sell in like, say, that kind of 2 to 4 year range, just because the market has been so hot and cap rates keep going down that it's, when you're hitting your target returns in 2 years, it makes sense to just sell at that point. So, but we underwrite to 5. So, we're always prepared to hold longer, just, if the market turns, if it's not an opportune time to sell. So yeah, I would don't expect to have your money back in less than 5 years, even though there's a good chance you will.
Nicole, what was the question that you had that we answered?
Kind of what to expect if you're a new investor, which you were saying with the 9 to 12 months, don't expect to get like a lot of funds up front. I was like, oh, well, you know what? That was actually my question. So good to know on that one. Because I'm a young investor myself. So I was like, okay, any advice that I can actually learn from this too,
Yeah, I think I would say the exception to that kind of like 9 to 12 month rule that Perry is talking about is like the people I see getting into deals really quickly are people that have a network already that they can raise money from. So like, sometimes I'll meet like, a new sponsor, somebody who's just trying to become, GP for the first time. And then like 2 months later, they're already in a deal. I'm like, how did that guy get in a deal so fast? He's like, oh, well, he's like a doctor and he has this whole network of like doctor friends that want to invest, right? Or he's, was already in investment banking or some industry where like he already had that, or tech, right? Like Perry coming from tech had a really strong network that we could draw on, right? Whereas me, like I have nothing, like I couldn't raise $1. Yeah, like when we started out, I couldn't raise $1, like literally. So, it kind of depends a lot on where you're coming from too, and what you're bringing to the table, right, as you get into the business.
I know it's really cheesy, but it's such a true saying. Your net worth is worth your network. It's like vice versa or something like that. But net worth equals network.
Yeah,
that's what we always got a network, right? That's why we're bringing those in-person mixers back. That's why we're doing these kinds of webinars, our happy hours, things like that. So, well, haven't seen any new questions. Yes, Manny, your net worth is your net worth.
Yeah.
Oh, same person was also asking real quick, how do you advertise?
I can take that. We have a good division of responsibility. Ed and I, we've been business partners for so long. Ed is kind of the underwriting, boots on the ground asset manager. And I take care of a lot of the investor relations and the capital raising. I do a little bit of the asset management. And Ed also does a little bit of the capital raising. All our deals are 506B, so we do not advertise it on Facebook or social media. And these are all friends and family and previous coworkers. The best way to advertise is by performing on your deal. That's my true firm belief. Our first deal, it takes a trust to trust us, and I think they invest in my deal because I have been in real estate for some time. They know we've been trying to get a deal. They know I have single families. They also know that I was a high performer at LIV. And so that's how they initially trust. No amount of like social media advertising, I think, could convince them any otherwise. So you have to know them. That's not a great answer because not everyone has that network. I admit that. But I do know that is just being a competent person in your day-to-day and doing well at your work and doing well in your profession means a lot. And people invest for competency. Now, getting into the second and third deals, it's about how you perform on the first couple of deals and how you communicate. So, yeah.
Well, and specifically, I see Rakshan is asking like how would they get involved. So yeah, obviously, since we do 506B, we do have to like have some kind of prior relationship, right, with all of our investors. So if anybody on the webinar is interested, you can just reach out to one of us. So you won't. Since we don't publicly market any of our deals, we have to have that prior, communication with any investors. So of course, if you're interested, you can just reach out, with our contact information that's on the screen, and then we can build that relationship, and then you'll be on our list, and you'll see what we're up to.
Yeah. There's another question from David about do you guys fund projects that other investors bring to you? Not a week. So the answer is no, but not a week goes by nowadays in which I will not ask to raise equity for other people's deals. But I only want to do deals that I have good vertical control. And I'm very cautious about my investor database. I could raise money every few months if I want to, but I chose to do like one deal a year or one deal every 9 months. And all my deals right now are with Ed because in order for me to raise money, I need to have confidence that the deal will actually do well. And it takes a long time to know that sponsor will do well. But I know Ed can take care of it. And so I'm pretty particular about what deals I raise money for.
Good answer. Absolutely.
Mm-hmm.
Guys, anything else? Any other questions? We had some really good questions here. Going once. Right. Going twice. All right. Well, guys, if you have any closing remarks, I have really, really enjoyed this presentation that you guys put on. As far as guys, if you want to play back this recording, we actually have it directly on our YouTube channel. We have it on our Facebook channel. They post automatically on there, so you can reference back to it at any given time. Make sure you subscribe to our YouTube channel so you can always see these kinds of seminars. Perry and Ed, we'd love to have you back at some point. And also, guys, and also check out our newsletters too. You also receive like a reference back to this one as well. So if you happen to miss the recording or you want to play it back, just wait for that email. Go ahead and go on our YouTube channel. Before we head out, Ed, Perry, do you guys have any closing remarks?
I think this is great. Thank you for having us here on this, and thanks everyone for coming on a Saturday afternoon. If you folks just let us know how we can do better in this webinar and in speakings going forward. I hope you enjoyed it. I hope you found value out of it. So yeah, just send us an email and or let us know in the chat there if this is helpful for you.
Absolutely, guys. Go ahead and write down. Oh, sorry. Go ahead.
No, I was saying thanks for having us. Really appreciate it. It was awesome.
Guys, go ahead and write down Perry and Ed's information. It's right on this contact screen. If you have any other questions for them, if you want to reach out to them, please take down the numbers, the emails, and then also there is a website on there for Cash Flow Portal. If you have any questions regarding anything about IRAs, how you can do these kinds of deals in an IRA, how you can lend out money, all those things, go ahead and give an IRA specialist a call. We have Manny in our chat box right now. You can email him at emmanuel.lewis@questtrust.com. So it's in the chat right there. Guys, I really hope you have a wonderful day. Halloween's tomorrow if you celebrate it, and I hope everybody has a wonderful spooky season. Other than that, I think we're going to go ahead and close out for today. So, guys, thank you for joining, and have a wonderful rest of your weekend. All right, bye, Ed. Thank you.
Yep.